This is the Wyckoff Starter Series seminar on springs and upthrusts. It is one of the places where we see the edges of markets very clearly, where we can place trades. But first, let us do our disclaimer. The substantial risk of loss in trading commodities, futures, and options, the past performance and indicative of future results, is opinions expressed by the Gary Full LTG LLC, and not to be taken as a buy or sell recommendations to sell commodities, futures, options for educational purposes based upon the teachings of Richard D. Wyckoff. So, one of the most important things about Wyckoff is trading at the edges. And trading at the edges simply is a factor of situation where we like to see the market where we see vertical and horizontal supply and demand bars that form our trading ranges. So if you go back and listen to the lecture on trading ranges, this would be very significant and very helpful in trying to understand springs and upthrusts. So it is said, and David Weiss, who's a Wyckoff expert, had made the commentary that if you have a situation in which you have a pond and you have a boat in the middle of the pond, and part of my drawing, this is a fisherman that has a fishing pole into the water. And what fishing at the edges or trading at the edges, what is very significant about that is that it gives us the edge of the market with limited risk. So limited stop loss, and gives us maximum type of trade in our favor. Obviously, there's a risk in every trade that we do, but we try to minimize the risk by trading at the edges. This example about the pond, if any of you that fish would understand this, and the market, the fish tend to congregate at the edges of the pond because that's away from where the boat is. Some dumb fish will stay here, and they're really not smart fish, so we really don't want to be in their situations. But the edges where fish stay is far away from the boat, and trading and around the edges that happen to be around the fish is where the fish stay. So this is very akin to what the market does. The market tends to have areas at the edges in which there's selling and buying aspects of the market, and we see that these are where the proper trades should be taken and to be at a point to where we should look to trade and put our area of resistance or support, we put our stops under those particular areas. So in this particular area, we see that the market is coming in from a downtrend situation or a negative background. Because of that reasoning, our trades should always try to be as often as possible with the direction of the trend or with the direction of the ease of movement or the background of the market. So we see a market that happens to rally from a low position, and we wait for some type of ending action to the upside to establish our edge. Well, our edge right here happens because the market tries to rally, has a decent type rally, and the market closes well off the high. If this market was bullish, we would have seen it close near the high of the particular move. But because there is little cause that has developed from the market's downtrend, this upside is very limited in scope based upon the point of figure charting and based upon the principle of cause versus effect. The less cause or sideways behavior of the market, the less the market can go up in the up or down direction. In this particular case, the market has some stopping actions point. If this market would have maintained the bullishness of the market would have stayed at the upper end of this range and would have absorbed the market. So you can refer back to the absorption lecture in the sequence of the webinars. So the market then actually has a retest lower, and we see that the market forms some type of range. So in this particular area here, this is exactly where we look at these dumb fish in the middle of this pond. We don't have an edge here in the market because it happens to be somewhat in the middle of the range. If we draw our line across from this buying bar, which is where we be a support, and then we put our edge at the top where we have this selling market, we should see that the market at this point has an area in which the market is in the middle of the range. So the level of knowledge in this particular area is very, very poor. So we either have to wait for a retest of this buying bar to look for a potential spring, or we look for the market to get to the point where we get to the resistance retest because of the background, and we try to sell the market. That is the preferable course of action, to be very patient within this trading range in which the market should retest. So we do have many types of springs. Wyckoff describes 3 types of springs, but suffice to say that, or an upthrust, suffice to say that a spring simply is a penetration of a support area, that closes back above this particular low. So this would be considered a spring in the market. Okay? If this market was in an uptrend, this would be the opportunity to buy the market. Okay? Now, sometimes we want to wait for the spring to actually close, and sometimes we want to buy the spring at the immediate support area. And that really depends upon a major factor. If we get a situation in which the market is going up in an uptrend channel, okay, or an uptrend move, and we get a situation where the market happens to be at a point to where we tend to have a break, and we want to place our support area in which the market has demand. If the market tends to go in a grinding session down, indicating a lack of supply that comes into the market, okay, we would like to buy the market immediately at the spring position, immediately at the support position, because this is a lack of supply that goes into the market, and we want to be a buyer of that support. Conversely, if we see a market that does the same type of behavior, in which the market tends to go higher, and we get a slam down in the market, okay, we would prefer to wait for the market to close above that area to prove that demand comes into the market before we would buy the spring. So in this case, when we have the slam down or the hard break to the market, we like to see the market basically close in the spring position before we will initiate a position in the long side to make sure that it truly is a spring and not some type of supply that could take us lower in the market. So, depending upon how we approach that spring will determine if we want to buy that spring. So again, if it approaches on increasing volume and large range to the downside in the market that's in an uptrend, we want to wait for the spring to close, buy that spring, and place the stop underneath the low of that particular spring. If the market approaches that spring area on a slow grind down, indicating a lack of supply in a bullish market, we would like to buy the market at the area of support, even though the market may spring for us, because we would anticipate a spring to hold in an uptrend. So the criteria for springs is that we like to buy springs in bullish markets, because those are the areas that are the edge areas of the market that we like to buy, simply because if the trend is up, that spring low should not take out a vertical demand bar. So we want to buy the spring with a stop underneath a vertical demand bar. If we buy a spring in a market that's in a downtrend, this is temporary stopping action to the downside before the downside is continued. So we don't generally want to buy springs in markets that are in downtrends, and we look to buy springs that are in uptrends. Conversely, an upthrust is a market in which the market tends to have a market that goes up and then the market goes above the resistance area and then closes back under this area. Okay? So what we want to see in the area of an upthrust is the market to be an upthrust to close underneath that particular area. Okay? If the volume is heavy here, it indicates that the funds and specs were buyers at new highs, and the supply came in by the composite operator who allowed the market to go up, filled the orders of the buys that the funds and the specs bought the market. He fulfills the liquidity to the market by providing the selling or the contracts or the shares of stock that the specs and funds want to buy, and then he sells into that particular area in an uptrend. Okay? In a downtrend. In an uptrend, upthrusts are probing actions to go higher. Springs and downtrends are probing action to actually go lower. So we'll show some illustrations in the upthrust and the spring position in this webinar. Since we are doing a starter kit, we will go into much detail as we can, but obviously there's much more on the topic, and what needs to happen, it needs to be examined in a much deeper realm, because buying springs and uptrends and selling upthrusts in downtrends is a very effective game plan in which we want to trade the particular markets. So we look for those actions. We look for those markets to do that simply because it gives us the edge and it gives us a proper stop to do so. So in the market that is a situation where we do have stopping action, we do have selling with a negative background, we are looking for the upthrust in the position of the markets. Okay? So in this particular case, we wait for the market to show some selling, which it did. The market's in the middle range with no edge. And then we see the market here where the market tries to go higher and immediately gets rejected, indicating that there's still selling that is occurring in the market. This selling occurring in the market is important because it tells us the ease of movement ultimately is in the downside of the particular market. So as the market creeps up to this point here, the market creeps up in here, showing not a lot of demand in the market. The proper trade in this particular point would be to sell this area right here, the exact selling area of the retest of the stopping action, and our stop would be above this particular high, because this is where the market had stopping action, where the market ended up breaking. So we want to put the stop above the stopping action bar or the vertical selling bar in the particular market. Okay? So we wait for the market to give us the edge. Since we have no edge here, we need to be very patient for the market. In this case, the market approaches this particular area, and the market then gets to the point where it has a very, very small range bar retesting the stopping action bar. So this is stopping action. This is a grind higher. In the market, and when it gets to the area of the stopping action bar, our sell is this particular area, and the market breaks. Wyckoff's favorite spring and favorite upthrust that Wyckoff used for the most part was a slight penetration of a reactionary high, and then the subsequent follow through to the market. Okay, you also see some wide type of springs that the market will go sharply higher in upthrust as well. But Wyckoff preferred the market make a slight penetration of a high and a slight penetration of a low. So in springs, as I said, they come in different forms, but what happened in upthrust, they come in particularly different forms. So in this particular case, we have a small range nudge to the market, a small range, penetration. This is also what we call a shortening of the upward thrust. Which is also ending particular action, which closed underneath, and the key is to see the follow-through selling. So this is an example of an up thrust in a market that has a negative background that goes to the market. Now, as I mentioned before, we have two types of various springs at this point. One, we have a situation where we see a spring, and this is the case at this point, where we developed a trading range, or up thrust, in the range wise, coming from selling, our background being negative, and we get the up thrust that occurs in the trading range and just above it to go lower. We also have a type of up thrust where the market can be higher here one day, and the market could end up doing this and also become an up thrust, like a 1 bar up thrust. Okay, in situation. So it could be within a trading range that penetrates the creek resistance, or it could be a 1 bar up thrust that the market goes above the resistance and then closes back under the resistance. In this particular case, we have the latter one, in which we have the up thrust that occurs in the particular trading range that we see. So this is an example of an up thrust, a very nice up thrust in the market, in the bean market, which also had follow-through to the downside. Very key. We would expect follow-through to the downside when the market is negative, has a negative background because of that reasoning. Okay? So that is a very important aspect of the up thrust, and it's a very high-level type of market that could be at a point where we want to be making our trades. And you see it's a very successful up thrust because you conversely see the market is going down to the market. Okay, going down to the market. Okay, so a very successful example of an up thrust in the market that is negative. So the key is in the up thrust is to have either a downtrend or a negative background in the market, and we can place the trade. Had we conversely, as I mentioned earlier in this webinar, had we conversely had a wide bar that would have done this to the market, we would have waited for the close of the market versus not to. So if we would have had a wide bar in the range and then do this, we would have to wait for the closing bar in order to get short down here with a stop above this level. If the market would have had strength in the background, we would have waited for the market to close because we don't know if that strength is going to follow through, or we don't know if that strength is going to immediately fail. So this is an example of a Wyckoff type of spring that was successful because of negative in the background and because we have selling that occurred in successful retail. So let's look at another market that's a little bit different type of up thrust, but nevertheless an up thrust. So an up thrust that comes from selling in the background versus necessarily maybe the trend not being that way. So we see an example of this that tops out in the corn markets. So we see that the market happens to be in a downtrend. The market happens to be in a downtrend. This is the difference of the rover contracts. The market actually did not gap like that. Okay? So we are coming from overall weakness in the market, but we have an immediate uptrend in the market. So in this particular market that occurs here, we now see the market was counter-rallying up from the market going down like this. The market had a counter move up. And we see several instances we see the market overall in a downtrend, but an up channel in the market. So we wait for some type of selling to give us a very good reference of where to sell the market on the retest. So this way we can sell the market with a good certainty of being successful. So let us put the volume in this particular chart. Now let's see if we can ascertain anything from the volume. So in this particular market, we have a wide bar to the upside, and we have a close that's on the low. Okay? If we take this particular line and we take it like this, we will see that the market had very high volume action as the market went higher and immediately sold off and closed on the lows. Because what happens is that this market made a high here, made a high right here, and the market then retested that particular high right here. The key to that bar is that do we stay near the highs to be absorption, or do we get selling? Well, in this case, we have a high volume, large range bar in the high. So we know that funds and specs will tend to buy new highs because the momentum traders, and it's true that most successful traders are trading the longer term time frame versus the short term time frame. So in this particular case, we see a very high volume bar as the market went above this resistance, hit the buy stops, or these traders that buy breakouts looking for trend. They get trapped above this market. The composite operator then goes in and sells and provides the liquidity for the buyers that buy the market above the support, above the resistance line. In this case, the market has stopping action and a retest forming an upthrust in the markets. Okay? And the market plays around and it doesn't break. So now we take away this particular line, we could change our line and put our reaction where the market actually got this particular selling. We mark that high. The market then tries to break. We also mark this selling bar that occurs to give us the edge of the markets. In this case, it's a beautiful upthrust. It's a beautiful upthrust of a selling bar, and it's a perfect retest of the supply bar that came right there. So we have this area to look for in here for an upthrust, as well as the market. So the property is an upthrust. So we get the upthrust in this particular area, and our stop will be just above this area high here. Because if the upthrust fails, then we don't want to be involved in case the markup has some follow-through selling. Since the trend was up here, we have to be aware that this may not be an upthrust, but if you look at the larger picture I showed earlier, we're actually in a downtrend but trying to counter rally. So those are the points at which selling the upthrust in the background trend being negative is positive. So we see the market have a wide range bar, upthrust, and close on the low. So this would be an example of the market being at the point in which we have the market vulnerable to a break because of selling background. So we'll see that this upthrust that occurred, we want to see if it happens on high volume or it happens on low volume. Okay? Well, in this case, the selling came from this area here. See the close? The selling, the largest volume, also came from here. This volume is high relative to the area that it's in. The close on the lows tells us that that high volume that was created by the funds and specs buying new highs, the CM decides to sell into this particular rally. The CM sells into the rally. And causes and overwhelms the amount of specs and funds buying. The high volume reflects the action by the funds and specs trying to buy the market higher, looking for a breakout to the upside. In the market, then all of a sudden breaks down in the market. All of a sudden breaks down the market. Now, as I said earlier, we like to see the follow-through that occurs in the market right after the upthrust is formed. In this particular case, when we get the selling with the high volume, the next several bars that we see are generally light volume action and the inability of the market to rally. So the small ranges are not able to even retrace much of this selling bar that occurred. Okay? So that is something that is a critical aspect of the market. So either the market has followed through to the upthrust down, or the market pauses, forms some type of bearish behavior, and then we see the market ultimately have followed through. So in this particular case, it's reverse absorption or resorption to go lower. Small range bar here is a lack of demand that happens after selling that occurs in the market. The inability of the market to go up and make new highs after that stopping action volume of the upthrust says to us that the market is not a shakeout, but one in which they should continue the down move. So, in this case, it forms some type of hinge, some type of reverse absorption, and then the market goes lower. Okay? So that is something that is very, very critical to what happens, because it allows the CM to talk to each other by selling into the rally at the highs versus not selling into it and causing the absorption process. So we see that that selling was indeed selling because the volume it increases as they take out buy stops, increases, hitting those buy stops and unloading the market to the downside. If this trend was up, and in the background, this trend was totally up, totally from down here, then this market could be supply still coming into the market. We would have to see the subsequent market behavior behind it. Okay, so we'll see what happens. So the market starts on its little journey down, and then we see some type of one bar reverse I mentioned, which the market got to the point where it reacted higher and then stopped some resistance here and basically stopped at resistance. Okay? And it also forms an upthrust of the previous bar. Let me draw that so you can take off the slide. Okay? So that is very, very, very important. This becomes a stopping action in the market breaking down. Since the market is in a weakened position, coming from a background negative, this small range is reverse absorption. So instead of absorption going in the sense of going to the upside, we could have absorption that also goes to the downside. But the inability of the market to rally back after the upthrust, this is a situation where it's a lack of demand, it goes lower, and we shouldn't buy the spring. So an example of a spring that we would not want to buy is right here. Yes, it's a shortening of the thrust in the market, shortening the downward thrust in a spring, but the background is negative. As I told you earlier, springs tend to fail in downtrends because that's not ending action for that particular thing market-wise. So, Having said that, upthrust, lack of demand leading to lower prices. This shortening of thrust in spring fails because the trend is down. So we are looking for some type of trigger, and we see that in that one in that particular market. Okay? If you recognized that this was some type of upthrust, which it would be, right? So we see the lack of demand coming into the market, and then ultimately the market needs to go lower because the trend is down, because we are at the resistance area. So this would be considered fishing at the end of the pond. Okay? So very, very important distinction. So you can say, well, Gary, it's an upthrust, you should go higher. Overall, the market, it showed you, is it a downtrend or neutral? It's that. But, having said that, I see selling. Okay? So the close off the high is selling. Talks to the market. By price action with the CM is defending the resistance area of the market and subsequently going lower. Any type of rally we get no we don't get no demand from that rally. It's indicating that supply or bearishness is still involved in the market, and then gets to the point to where the market has an upthrust and breaks. Okay? Very, very important. What Wyckoff also work told us that we mark the reactionary low of the market. Okay? So this would be considered a retest for the market to go high. This would be the area that you'd expect a spring from. Because the market had selling in the background and broke underneath this ice support area, because of all the ice area. So we see the selling in the background, the lack of demand, market situation being somewhat negative. In this case, we wait for the stop reaction to occur in the uptrend. We sell with a stop above here. This is a situation where it shows lack of demand after the upthrust, and the market will go lower. So upthrust can happen in downtrends, they're very effective, or they can happen when the background is negative. Even though the trend longer term may be positive, if you're scalping a very short-term basis, you'd want to take this particular trade because it's an upthrust of a market that came from weakness. You subsequently see the markdown phase of the market occurring afterwards. Usually we get a retest back to this ice area to sell. We didn't get a retest after the market, showing the weakness of the particular market in this case. So fish the edges. In the case of a spring, wait for the spring. In the spring, in the case of the market, it's in an uptrend. You want to buy the spring. Market's a downtrend. There are some cases where that happens, but we'll stay away from that in the beginning. So portion of the beginner portion of this of the starter kits, because you can go into much deeper detail as far as that's concerned. Okay, this is an example where the market tried to upthrust the market. The market tried to, tries to upthrust this high, closing lower, but there's no cause in the background of the distribution, so that upthrust is a probe to go higher. Even though it's a poor close, in the market, it doesn't show supply coming into the market. And since there's no cause built because the market has been going up, since there's no cause of distribution to the market, then we have to see the market. We'll see the market take this out and go higher. Because this is a markup phase, this is just a temporary, and the market you see takes that out like butter, as far as that goes. By the way, this is why you'll see the support holding right here because of the reactionary high. Pardon me. So up thrust in downtrends or up thrust in downtrends is ending action to put the position on for the market to go lower. Pardon me. So in this case, the selling in the background, the retest creates a up thrust, and the market subsequently breaks lower. The market was coming from here, right, which it did, but then it got this rally here. So we still have a situation where the market shows weakness and the retest should be sold. So a couple markets that have now springs and up thrust. And we talked about the up thrust. Now let's talk about these springs. The best illustration in these springs probably is the S&P market. So this chart is in the Arctic series, however you're reading it, you may have gotten that point. But we see something very, very important, because we clearly see the market in a situation in which the market is in an uptrend in the market. It's an uptrend in the market. So let's take the more obvious type of action of the spring here, and we can see something very, very important. We get that demand bar that's created right here. Okay? Demand bar that's created back here, and the market then retests this vertical demand bar. The market retests that vertical demand bar, and this is the place that we want to buy the spring. This is that slight penetration spring that Wyckoff thought was a more proper spring to buy, one that wasn't shallow in nature. And then we get another retest here, so you can even get these little springs, right, here and here. I don't know situation-wise. So the uptrend, we want to be able to buy the spring. We can buy those springs immediately, and the close tells us that the market is good. Now, when you get a close that is very high-end with a large range, so if you get a situation where you get a market that you're waiting for the market, and you get a situation where the market has a break like that, and then closes here in a penetration or spring of this particular low, okay, we wouldn't want to buy the spring here and put the stop too far of the situation where the market stops. It's too far away. Okay, it's the proper stop area, but it's too far away to assume the risk. If the market gets to the point where it goes higher, then forms something like this, we could buy this here with a stop here, because we're right for the accumulation aspect of it. We're risking very, very small amounts. So in this particular case, we see a spring of the demand bar, which is perfect. Also, we see a penetration of the market here. We also see a spring that occurs in the market. And notice the closes are very high end. So I'd rather have you not chase the market and wait for some consolidation in the market and then take advantage. But if you get a situation where you have a wide swing up thrust and a wide swing bar, and your stop's got to be above it respectively and below it respectively, okay, it makes it very difficult for a market to quantify the risk of the market, because you're so far away from that danger area of the ice in the creek area. So you're far away from that particular area, and the risk to reward is not good. So if you get a wide spring that closes very, to the top, buying the spring is buying the up thrust in the market. Selling the up thrust with a large stop is difficult to do because you have to wait for a better level of knowledge of consolidation to do so in the market. Okay? So we have our spring in the market, and we have an example that we showed before. This is a market here. We see a spring of the previous bars in a very effective trade. Pardon me. So this is a current E-mini S&P chart. Okay? If we now take this and go to a 60-minute chart, we will see some nice springs of where we can take advantage of our knowledge. So this would be an example of a spring that we just talked about that is too far away from the danger area. So if you were to buy this market here after the spring, it would be too cost prohibitive to put the stop down there. But that's the only place that you can put the stop. But you don't want to get stopped out above support. But that could be a very large risk. If it's a very large risk in the market, stay on the sideline. Only trade when you have the edges that occurs in the market. So this market in a very nice spring, too far away from the danger area. Okay, so I would not buy this particular spring here because of that reasoning. It's too far to place your stop in the market in order to make that effective. And it's a wider type spring, which Wyckoff is not a tremendous fan of relative to the short springs. Okay? So, this would be an area where the market has some type of retest, forms a little spring of the previous lows, closes high, the market retests. This is like a very bad close type of thing. Okay? Very bad type of action-wise. And we see the spring here begin to fail, and it probably knocks you out of the box when the market makes it low. This is the current chart of the E-mini S&P. Okay. So, in the back, so this is another example of a spring that would be prohibited to buy. Would be a situation where the market could also take out a penetration of a situation of ICE support. It could penetrate that ICE support and close higher, and this market would be here with a stop here. It's too cost prohibitive to do that. Okay? So this is the market where the market tended to have high here, but we have no cause to sustain it. The market then builds cause here, gets above this area. The market is selling, the retest in the market shows more selling by the market as the market goes up. Remember, upthrusts and uptrends tend to fail, but funds and specs don't care. They look at the momentum traders. They look for the market to move up or down, depending upon, and it depends if they defend it or not. But these are buy stops that got hit in the market, getting shorts out, getting more longs in, and the composite operator is selling them basically at a retail price because he's able to do that market-wise. The market breaks down here, forms the proper upthrust in the market that is bearish. So springs can have very, very high volume and close, and springs can have very light volume. Well, what's the difference? A spring that has very light volume tells you that there's really no selling at that ICE support area. So that penetration tells you that that's something very, very important. When we see a wide spring bar with large volume, obviously there's a transfer of risk. The volume indicates the volume going from the weak hands into the composite operator with the large volume, wiping out maybe those underneath support, those above resistance. So the high volume springs it means that there's a great transfer of risk between the markets. This market sharply with high volume indicates the fuel and indicates the importance of the large volume, but it really depends on the close. If you get a spring attempt with very large volume, the market closes on its close, the potential spring is probably not there. So we are always looking at a situation in which how we get to that support and resistance. But springs can happen on, and upthrusts can happen on markets that are weak or that are strong. Obviously, markets that are weak, it's effectively we take the upthrust. If that volume in the upthrust is high, it's the composite operator selling what the funds and specs are buying new highs. If the volume is high, when we get to the point of a spring, then it's taking out the longs under spring and maybe establishing more shorts as the market takes a place where it penetrates underneath the spring level on that high volume. That high volume indicates a tremendous amount of risk from the funds and specs to the composite operator. The strong springs in uptrend are the ones that have followed through the upside. The strong upthrusts and downtrends are ones that have supply from the upthrust position in the particular market. So as we go towards, we continue to go situation Y, we will see the market currently, and we see the market, the poor reaction of the spring so far here, because we're not going higher into the market. Okay? So if we continue to go through this particular market, you will see examples of springs and upthrusts. Okay? We like the springs that are in trading ranges because in upthrust, because that gives us a good level of knowledge, because a good risk reward. So in other words, if I have a trading range that is very, very long in duration, market's going uptrend. Okay? If we have cause being built and we have an upthrust, then we get to the, or a spring, depending on what it is, the larger the cause, we don't have to be so accurate. We have the cause built, or to be too early, simply because that cause built, if all you have to do is catch the direction of the trend of the market. The larger cause that's built in an uptrend that makes the spring, even though the spring value may be a little bit more risk than you want to take as far as money-wise, the large cause will eventually give you a great risk-to-reward ratio in the markets. Okay? And that's very, very, very important. Again, sometimes springs are wide. Usually they're one bar, but you can see the market, becomes a 120-minute spring, right? Because it takes 2 bars for the market to penetrate. This is not a spring at this low, but this happens to be one. Here, we have a market that's coming, forms some type, trend overall up. This is a spring that occurs in the market, and the immediate rally in prices. So that's considered a very good spring because the market has followed through to the next bar, and the market then immediately starts up. So that was a good area of spring to buy the market. So we'll carry the back running backwards, because coming from strength, but the market's ability to hold this as a spring has followed through the upside. So we just go through this, look at things. This is a situation where, again, we have a spring that occurs in the market. Okay, here's an example of a spring that closes very well from an area of clustered lows. See these cluster clues here. The market has a successful spring of the market. So we can have a spring that retests a vertical bar. So stopping action, but create demand. This would also be a decent area to look for a particular spring in the market. If the market has established the up, the retest down should be lost. So, you see, so we recap spring-wise and upthrust-wise. We get a market that goes sideways, and the trend is being down. We want to take this upthrust bar because the background is negative. So in trading ranges, okay, that builds the cause. That cause was to see how well the upthrust or how well the spring is going to react to the market. If the market gets there on high volume, retest of a spring, wait for the spring to close. Happens on a light volume grind, you could buy the market as support. The same is true as the upthrust. Depends on how we get there. If we get to the upthrust with demand in the background, we would have to wait for the close. We have a market that creeps up to resistance, penetrates the creep very smallly, it's very small at the top of that range. We could take that range and assume that you're going to get the upthrust in the down market. So that is something that is very critical. So we like to buy springs in markets that are uptrends. We like to sell markets that are downtrends. We want to sell the upthrust. And the key is to run away from that danger area. If the market does not run away from that danger area, then to what you identify as a spring and or an upthrust is probably not there. So you want to trade springs from the long side in bull markets, and you want to trade upthrust to the downside in markets that are bearish. We want to go with the trend in the background as quickly as we possibly can, because that gives us a very high-level knowledge to the market. So one of the reasons why the course, the market-wise, is a starter series, occurring-wise, is to give you a little flavor of something that is very, very, very critical to what happens. So we want to look at those edges. Now, there's a lot more to be said about springs and upthrusts, okay, outside this starter system, but I wanted to introduce that Wyckoff phenomenon to you because David Weiss said, and I also believe, you can make a comfortable living in buying springs and uptrends and selling upthrusts and downtrends. It makes sense from the standpoint of trend. And we know how important trend is to markets. So we want to be able to use that trend in our favor market-wise. So, as I said, there's a lot more on the subject, and there's so many different facets of springs and upthrusts and how they get there that in the scope of what we're doing here is just too difficult. So I want to conclude this webinar from the standpoint of springs and upthrusts. Again, we can find them in trading ranges, or we can find them one-bar springs or one-bar upthrust. And how far those upthrust or spring will go will base upon the sideways behavior of the market. The longer the sideways for an upthrust, the more sideways for a spring, the more bang that you get for your buck. So that's a little introduction about springs and upthrusts, and we will conclude this portion of the webinar of springs and upthrusts. Thank you very much. Goodbye, everybody.